Financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. We have a great podcast episode lined up for you today. Today, we're going to be talking about why the rich get richer. This is episode number 432. And this is an interesting topic. I actually talked about this topic with our members several months ago. There was an interesting study that was put out that I want to talk about on today's broadcast. And it was a study that was conducted by 5 economists from Harvard, Princeton, the University of Chicago. We're going to talk about it. It was entitled Asset Demand of U.S. Households. And basically what we're going to talk about is, as the title suggests, why the rich get richer. It seems like everybody knows that phrase, the rich get richer and the poor get poorer. And what I want to do is I want to kind of use this study to peel back some of the reasons why this exists. And I know that many of you who listen to this podcast regularly, faithfully, you're obviously looking to improve your financial life. You're looking to improve your financial situation. You're wanting to achieve financial freedom. You want to provide a better life for your spouse or for your family or for your children, your grandchildren. And you're looking to be a wise steward of the finances that have been entrusted to you. And as such, you want to just maximize your resources. You want to use your time wisely. And therefore, understanding some of these topics that we're going to be talking about, I think, will greatly enhance your efforts. It will greatly enhance your, helping you achieve the goals that you've set for yourself. So we want to talk today about why the rich get richer. And the answer is probably not going to be terribly surprising, but it is a scientific study that I think pretty much just proves what it is that makes the rich different than the poor. And there's probably many different things. Of course, we can't just nail down one specific trait or, some habit that the rich have that the poor don't. But nonetheless, I believe this is going to be very helpful to you. By the way, the last few episodes on Follow the Money Radio, we've been talking about trend trading and swing trading. We've gotten some good feedback from you. I really appreciate hearing from you. Anytime you want to reach out to us, just go to followthemoney.com/contact. You can shoot us an email. Maybe you have a request for a future podcast episode topic, or maybe you have a question for us. Feel free to send those to us, followthemoney.com/contact. We always love to hear from you. Now, let's move into today's broadcast, because what I want to do is I want to begin by talking about wealth and poverty cycles. So when you look at some of the statistics, it's pretty grim. Some of the statistics are really grim. The top 1% of American income earners own more wealth than the bottom 90%. Have you heard some of these statistics? It's pretty crazy. I mean, when you look at how unequal the economy really is, the income inequality, it's really stark. But the cycle of wealth and the cycle of poverty are really shaped from a very early age. So our own personal view of money is going to be shaped and influenced by at least 3 factors. And I detail these in my book, Bankruptcy of Our Nation. The first one is the economic system you're born into. So that certainly is going to dictate to you how you view money, right? So if you're born into a capitalist system versus, say, a socialist system or a communist system, you're going to view money differently, just straight up. I mean, because there's just a different approach to money in those different types of systems. So whatever system you're born into, that's going to greatly influence how you view, wealth and money. So too, another very important, determining factor of how you're going to view money is, and I'd say this is one of the strongest, is your family's financial philosophy. We're really products of our environment. And so when we think about how we were taught about money, maybe we weren't taught specifically about money, because sometimes parents don't like to talk about money with their children because it's taboo or they don't want to get into the details. And that's unfortunate because sometimes you could really pass on some good ideas to your children. And this is what we strongly encourage, of course, for our listeners, is to have a great conversation with your kids about money, teach them about money, teach them what you've learned so that they can become, better stewards as they get older. But, our family financial philosophy, family financial philosophies are greatly going to determine how you view money. So if your parents learned, a poverty mindset from their parents, and that's how they operate today, well, it's probably going to be what you're going to pick up and what you're going to continue in your own life. And then, of course, it's just like a cycle. Then your children see that, and then their children see that. And so somebody has to break the cycle, where if you live in a cycle of poverty where you have lots of bad or negative financial habits that leave you in, debt, constantly in debt, constantly facing bankruptcy or foreclosure, or you have, debt collectors contacting you. This is a cycle, and people can end up in that cycle just because it's what they learned. The third, way that our view of money can be shaped and influenced is really by our instilled spiritual and moral values. So if you grow up with a particular faith tradition that teaches you that money, is to be used a certain way, well, that's certainly going to impact, how you view money and what you do with money and how you value it and how you esteem it. Money really is morally neutral. It can be used for positive reasons. It can be used for negative reasons. And as I've often said, financial morality is found in the intentions of the user, not in the money itself. So we do have, wealth cycles and poverty cycles, and the cycles of wealth and the cycles of poverty are going to be determined by at least these three factors. And we are certainly products of our environment. Now, one thing that we can say for sure is that all of us have financial habits, right? And financial habits greatly matter. So I'm going to get into this study here in just a minute, but before we do, I want to lay a little groundwork here and talk about habits, because that's really what we're talking about when we talk about these wealth cycles or these poverty cycles. Whether you're in a poverty cycle or a wealth cycle, it's really going to be determined by the things that all of those three factors we were talking about, what that ultimately leads you to do. So what are the habits that are formed as a result of those things? The economic system you're in, the financial philosophy of your family, and your spiritual values. What does that do? How does it cause you to act with money? What are your habits? What are your financial habits? Habits are automatic. They're repetitive behaviors, and they're formed over time, through consistent repetition of a particular behavior. And once you establish a habit, it can become ingrained in your daily routine, and then you perform it without any conscious thought or effort. Perfect example is just brushing your teeth before you go to bed. If that's just a habit, you just do it out of, subconsciously. You don't even think about it. Or maybe, you maybe have a habit of checking your phone every time you wake up in the morning. That's just a habit. It's just what you do. Or maybe procrastination. There's obviously bad habits you can develop. Procrastination is a habit. So you can procrastinate and then procrastinate again and then procrastinate again. And then pretty soon you see you're just always procrastinating. Or maybe it's a bad diet. Or maybe a good diet. Maybe it's exercise that's a habit, or meditation. These are good habits. Scripture reading. Maybe you read the Holy Scriptures, or maybe you like to learn, or maybe you make it a habit of learning. Maybe you make a habit of smiling, right? Some people have a habit of not smiling. Recently, we had, my wife and I had our third boy, and he is still, less than 1 year old. And this little baby just always smiles. Like every time you look at this, this little baby boy, he is smiling. And he has caused me to begin to develop a habit of smiling a lot more because of his constant smile, and so it's funny how others can have an impact upon our own habits, And so obviously smiling is a good habit, or we can get into having dinner with as a family. That can be a habit. Tracking your spending, that can be a habit. Spending time in nature. You can make habits that are good for you, and you can make habits that are bad for you, right? Habits can be positive. They can also be negative. So your habits are obviously going to have a significant impact upon your life. They can affect your faith. They can affect your health. They can affect your relationships, your productivity, your overall well-being, and obviously they're going to affect your finances, right? Undoubtedly. So developing positive habits can help us achieve our goals, whether we want to improve our health, whether we want to improve our finances, whether we want to improve our relationships. And just inversely there, just as positive habits can help us achieve goals, negative habits can hold us back. Okay. So this is really what we're talking about now when it comes to the wealth and poverty cycles, that oftentimes the person who is doing well financially has financial habits that are positive, right? And the person who is in a cycle of debt, in a poverty cycle, you will often, if you examine their financial habits, you will find that they will be negative. They will be destructive. They will be self-defeating, right? And so financial habits really do matter. And the truth is that your future is hidden in your daily routine. So what it is that you do on a regular basis, of course, is going to determine where you're going. You're not really just the sum of all of your habits. You're much more than that. But you could say in some way that you are a sum of, in some ways you are a sum of your decisions. You're a sum of your habits. And so I think as we lay this groundwork, it really helps you understand that your financial habits matter. And so you really want to examine them and make sure that they are things that are not negative. They're not destructive to you, because otherwise you'll get 1, 2, 3 years down the road, or even 5 or 10 years down the road, and you'll realize, wow, I wish I would have developed this better financial habit earlier. Or, we're not talking about health today, but, maybe a different health habit. So your habits matter. That's the point. Your financial habits definitely matter. Okay, so let's dive into this study that I was telling you about at the beginning of the podcast. This is the study that I wanted to talk about. This is a study. It's a 52-page study that was released back in October of 2022, and it's entitled, if you want to look it up, this academic study is called "Asset Demand of U.S. Households." We'll put a link to it in today's show notes. And basically 5 economists from Harvard, Princeton, University of Chicago, what they did was they analyzed detailed monthly portfolio data from a wealth management platform used by investment advisors. And what this did is it gave them information on around 139,000 household portfolios. These are investment portfolios. And when you look at it, you'll see that these portfolios totaled nearly $2 trillion in assets. So we're talking about a pretty decent sized sample, decent sample size. Now, what this study did was it looked at what those investors did by month from January 2016 to August of 2021. So around almost 5 years, right? Or maybe a little bit more, maybe a little less. And that time frame, by the way, included the COVID crash of March of 2020. It included the turmoil all around the 2016 presidential election. It included the sharp market sell-off in late 2018, Q4 2018. You may recall that if you were investing or trading back then. And then, of course, 2 really big, hefty booms during that time frame. So this was a really interesting and volatile time to be doing this study. So again, from January 2016 to August 2021. And what they did was they just parsed all of the data to see what was going on in these portfolios during that time. And most important is that the economists were able to group the portfolios by size. And the sample included nearly 1,000 ultra-high net worth households with more than $100 million in assets each. So the ultra-high net worth households, which again, more than $100 million in assets. That doesn't describe most people, right? It's a pretty rare thing, but they did have 1,000 of those in the sample. And so that is going to provide us some pretty interesting information. Now, let me quote you something from the study that I think is very interesting. This is a quote. It says, "We estimate how the flow to liquid risky assets responds to aggregate stock returns across the wealth distribution. And quite strikingly, the report says, we find that the sensitivity declines sharply in wealth. In fact, the flows of households with assets over $100 million are essentially insensitive to stock returns." Okay. So in other words, what this is saying, what this study basically found by looking at all of these 139,000 different households and their portfolios, is that the more money that these individuals had in stock market assets, stocks and things of this nature, that their sensitivity to the volatility, right, in the market went down the more that they had in total wealth. So, and as it points out there at the very end, the flow of households with assets over 100 million were essentially insensitive to stock returns. So it didn't really matter what the stock market did, that there would be very little response by those with ultra high net worth to what the market was doing. Like, it didn't matter. Like, they would continue to do what they were doing no matter what the stock market was doing. Okay. But the less that people had in assets, the more sensitive they were to the stock returns. And so if the stock returns were lower or they went down, well, then you would see that there would be sensitivity to that with the less that people had. It almost makes sense, when you think about it. Here's another takeaway where from the study. It says, while less wealthy households act procyclically, ultra-high net worth households buy equities during downturns. Now, here we really have the meat of the matter. In other words, when it says, while less wealthy households act procyclically means buying after the market is up and selling when it is down, right? And indeed, these ultra-high net worth households are so counter-cyclical that they help stabilize markets during downtrends. Because they don't sell, the market is more stable, and they're the ones that are buying when others are selling. So when you think to yourself, well, if the market goes down, what are these ultra-high net worth households doing? Well, according to this study, and this is just one study, but according to this study, they buy equities, or that is stocks, during downtrends. And while less wealthy households, what do? Well, they sell when the market downtrend is in place, and then they only buy after the market has gone back up, right? So in other words, there's a very different approach to buying and selling stocks between those who are more wealthy and those who are less wealthy. Now, you just got to realize that if you're going to invest in the stock market per se, that markets are going to go boom and they're going to go bust. That's what happens, right? So you know ahead of time. Everybody knows this. And if they don't, they learn pretty quickly when they get into the market that the markets go boom and the markets go bust, right? They go up and then they go down. And then sometimes they go sideways. Okay. But smart investors, and what this study is showing is that the savvy, higher net worth investors put cash to work in busts. So when the market goes down, they tend to buy, and then they tend to take cash off of the table in booms, right? But again, the main thing is that the ultra high net worth individual appears to be insensitive to market returns. So not selling when the market is going down, instead buying more when the market goes down. Now, that all sounds, easy, but it's much easier said than done. As with all things, it gets easier with practice. So here's the takeaway from this study. The big secret, and I think this is something to really think about, is that the secret to successful investing, at least according to this one study, and this study, by the way, is backed up by many other studies. I mean, this is pretty. I think this is pretty obvious when you really think about it. You got to think about it though, because it's not so obvious. The media doesn't tell you to do this, and the average person doesn't tell you to do this. But when you look at when you follow the money, when you actually look at what people actually do with their money, like they did in the study, you'll see that one major secret to these high net worth investors, their successful investing, is to never stop buying high quality yielding assets during your working lifetime. To never stop buying high quality yielding assets during your working lifetime. Now remember, we're talking about investing here. We're not talking about trading, because trading is a totally different beast, right? With trading, you are seeking to avoid downtrends. You are seeking to get aboard during uptrends. You are being proactive. You're either hedging or you're trying to speculate or take advantage of opportunities. But when we're talking about your investment portfolio, it's a different thing altogether, right? You shouldn't be hopping in and out of your investment portfolio like it's like a trader. I mean, the trader is trading capital that's separate from his core investment portfolio. And so here's the major secret, or the takeaway from this study, is that the very wealthy, the very extremely high net worth individuals, during that whole time of study, that from January 2016 to August of 2021, they never stopped buying high quality yielding assets. Whereas others did. Others would sell near the bottom because they would get scared, and they would close out their long-term holdings, say, well, I don't know what's going to happen, so I'm going to sell. And then they would come back and buy all that later after the market went back up again. So they were acting like traders with their investments, right? Whereas the high net worth individuals don't act like traders with their investments. They keep buying more when the market goes down. That almost makes sense. I mean, in fact, it totally makes sense. For example, if you're going to buy assets, if you're going to, say, I'm going to be an investor, what are you going to do? We're going to buy assets. That's what investors do. They buy assets. They buy real estate. They buy stocks. They buy, fine art. Whatever it is that they're buying. And in this case, we're talking about stocks. So if you are buying stocks and you're going to buy stocks, do you want to buy stocks when they're trading at a 50% premium? Or do you want to buy stocks when they're trading at a 50% discount? Well, the right answer is at a 50% discount, but that's not the way it always works, is it? I mean, if we're talking about a shirt and you say, we got to go buy a shirt. Well, you want to buy the shirt when it's trading, when it's selling for 50% more than normal or 50% less than normal. Everybody knows the answer. It's like ding, ding, ding. You buy it when it's cheaper, because you got to have it. And so you got to get it. Well, that's the same logic that investors should be using when it comes to the stock market. Is that if you have a high quality yielding asset that has been hit hard because of fear, volatility, or some other unknown that's just basically brought the price down. Well, if you're an investor, you'd say, well, that's the time to add more. That's a great time to add more, right? So how you can really take advantage of this way of thinking is to simply create a habit of investing. Well, we did a teaching on that for our members a year or two ago. It's a very powerful teaching we did for our members. It was called The Habit of Investing. And you just basically turn investing into a habit. Like you're always buying high quality yielding assets during your lifetime. It's just what you do. And if you do that, you're going to find that over time, you are going to do much better than the person who doesn't buy high quality yielding assets during their working lifetime. And you'll even do better than those who only buy high quality yielding assets in an uptrend. In other words, when everything seems fine. But when things go bad and everything goes on sale, that's the time when the ultra high net worth investor and those who are more wealthy, that's when they're buying even more. So it's counterintuitive, I know, but it's also intuitive when you think about it a little bit longer than just a couple seconds. I mean, if you really drill down, you'd say, well, yeah, the best time to buy an asset is when it's on sale, right? It makes total sense. But your emotions can get in the way. That gets us into psychology. This is not about necessarily, psychology today, investment psychology. It's more just about the actual actions. Now, this actually confirms something that I want to talk about. But let me just say that the secret here, before I go to that, the major secret here is just to keep buying high quality yielding assets. Just continue to buy them, right? We like to buy real estate, so we want to buy houses. We want to find more 3-bedroom, 2-bathroom houses. We don't want to stop. We want to keep buying them. They become more cost prohibitive now. Interest rates are more prohibitive as well, so we've slowed down a little bit because but at the same time, we're keeping our eyes out. We're looking for deals. The same thing with the stock market. You just want to keep buying. And if you don't want to invest in the stock market, then don't. But if you're going to invest in the stock market, you've got to remember that the way you do it is you buy when things are on sale, right? It's the same as anything else. So, the best approach that I believe the average person can use when it comes to investing, not trading, but investing, is to dollar cost average. Whereas you invest a little bit each week or each month, and you just do that and you make it automatic. You don't even think about it. You just automatically buy. You make it a habit, right? Just like brushing your teeth before you go to bed, just like exercising in the morning or whatever you do, you make it a habit where, hey, every week or every month or twice a month or whatever, I'm going to, invest into stocks or, bonds or real, whatever it is that you're investing in this case, stocks. And you just got to commit to it. This is a habit worth forming. You just got to do it. And I promise you that your future self will thank you, if you stick to a rigid dollar cost average strategy into high quality yielding assets, right? There's a very interesting study put out by Dalbar. I'm going to read you a little quote here. The title of this is Investors Experience Devastating Investor Performance Gap. And the study finds that the average stock investor earned less than 10% or earned more than 10% less than the S&P 500 in the year 2021, which marks the third largest underperformance ever observed by this study, which goes back to 1985. Before I launched Follow the Money, I was a financial advisor for a period of time. And I became familiar with this Dalbar study, and I couldn't believe it. I had to read it. And they put it out every year, and they've been doing it for like 28 years or so. And they study investor behavior. And what they find, it's a very grim picture that they paint, but they show that the average stock investor cannot beat the S&P 500 to save his life. He just can't beat it. Because why? Because he is motivated by emotions, and his emotions will drive him to sell when the market is down, when he should be buying, and then to buy when the market goes back up, when he should be taking some money off the table, right? So he does the exact opposite. So this is why we often tell people that, look, if you don't want to trade the stock market, if you don't want to get in the market, you don't want to pick individual stocks, if you don't know what you're doing, well, index funds are probably the best way because it's difficult to beat the S&P 500. Most mutual funds can't beat the S&P 500. The S&P 500, the top 500 companies in the United States, all put into the S&P, index fund. And then you just get this broad diversification. You don't have any single stock risk. And if you just dollar cost average, say, into SPY, well, you're going to get market-like returns. Now, you could beat the market by, drilling down and spending time. But if you don't have that time or you don't have the desire for that, well, then you can just invest in index funds. And that's a fine way to invest, especially if they're low cost index funds. But the point is that those who try to beat the markets usually don't, right? They usually don't. And so I think, this is a really important thing to realize, that investors have a real big performance gap between what they're able to achieve and what the average S&P 500 return is on any given year. They're usually underperforming. It doesn't matter if you look across the board, whether it's 12 months or whether it's 3 years or 5 years, 10 years, 20 years, 30 years. Investor performance over time just cannot beat the S&P 500. There's no time frame where you find that they actually beat the S&P 500. And again, let's talk about why. And I think this really kind of sums it up. We will talk a little bit now about psychology, just a little bit, just to help you understand this irrational investing behavior. The biggest reason for underperformance by investors in the stock market is psychology, right? So you have these behavioral biases. We were talking about these earlier, these things that we have, these habits that lead to poor investment decision making. That's the largest single contributor to underperformance over time, according to a Dalbar study. And the Dalbar study defined 9 of the irrational investment behavior biases. Number 1 was loss aversion. So when we think about loss aversion, it's the fear of loss, which leads to a withdrawal of capital at the worst possible time. It's also known as panic selling, right? So that's a really big one. People will panic sell, and then they'll go back and they'll buy whenever it's 30% higher. And so they're losing ground. Instead of taking advantage of the sell-off and the panic, they themselves become fearful too, and then they flee, and then they come back whenever it's higher, and then they end up with less shares, with the same amount of money. Or another one is narrow framing. That is, this is an idea where you're making decisions about one part of the portfolio without considering the effects on the total portfolio, right? That can also hurt you. Anchoring is the third one. This is the process of remaining focused on what happened previously and not adapting to a changing market. You get anchored, you get stuck in a moment somewhere, and you can't get over it. This happened to people in the 1929 crash. They just couldn't get past what had happened. Like it's stuck. 2008 did this to many people, where they said, they just couldn't imagine, or dot-com bubble, the same thing. Where people couldn't imagine that the market could go back up, but it does, right? So, and this is what we know: the markets go boom, and the markets go bust, right? So, as long as we know this ahead of time, then we can prepare for that. Don't think to yourself that you're going to start buying and the market's never going to go down again. You've got to prepare yourself to say the market is going to go down again, and what am I going to do? Am I going to sell at the bottom? No, I'm going to buy more at the bottom. Because why? Because it means the market's going to go boom again. It goes boom and bust, boom and bust, boom and bust. Right? And so once you learn to take advantage of the pattern, once you learn to take advantage of the ongoing patterns in the market, well, you can use it to your benefit. The fourth reason, or the fourth bias, behavioral bias that leads people to make irrational decisions is mental accounting. That is, they separate performance of investments mentally to justify success and failure. So that can often lead you to make poor decisions. A lack of diversification. Believing a portfolio is diversified when in fact it actually just has a whole bunch of, the same kind of correlated assets. This is something that many people will say, well, I'm going to specialize, in this particular niche. And then they go all in with all of their money into that single niche. Okay, well, if you're right, that could really work out for you, but that's usually not how it works. Usually you end up, getting hurt. So you don't want to be over leveraged in your portfolio. You want your portfolio to be well diversified, right? A nice diversified mix. And you're always going to be diversifying. Over time, you'll be rebalancing and all of this. And so it's not something that you just do once. You got to have that diversification mindset. Another behavior that limits people is herding. That is following what everyone else is doing. And that leads to where you buy high and you sell low. And this is where traders and investors can really, get mixed up. When you're trading, you have your trading hat on. But you got to take your trading hat off when you're an investor. So trading and investing are two very different activities, right? Just like saving and investing are very different, trading and investing are very different. You've got to know the difference. So trading, you're trading with the trend. We're trend traders and we're also investors. I don't invest as a trend trader and I don't trade as an investor, right? They're two different activities. So, so when you're trading, herding can actually be beneficial to you because you're staying on the side of the trend. Whereas when you're investing, herding can be a very negative thing for you because you're not taking advantage of, when markets go down. Obviously, you want to take advantage of markets whenever they go on sale. Another bias that's negative is regret. That is not performing a necessary action due to the regret of a previous failure. So allowing a previous failure to cause you to make more or to fail again. This is very common. So regret can really wreak havoc on your portfolio. And there's two more. Media response. Wow, this one's a big one. The media have a bias to optimism so as to sell products from advertisers and to attract viewers or readers. And so whenever things are great, they tend to be very optimistic. They tend to go in the opposite direction whenever the market goes down, and they can begin to scare people. So like people get scared by watching the media, and that can wreak havoc on your portfolio. The media is not going to help you, by the way, when it comes to your investing. They're just not there to help you at all whatsoever. You've got to learn this. The media is not there to help you with your investment portfolio. They're there to scare you, or they're there to inflate you with false optimism. Like they are rarely going to give you what you need to succeed as an investor. So remember, the media is not your friend. And then the final one is optimism. That is, overly optimistic assumptions tend to lead to dramatic reversions when met with reality, right? So usually, if you research some particular investment and you say, oh, I expect it to do really well, and you have an overly optimistic assumption, well, if it doesn't perform as well as you want it to, well, then that can lead to some pretty dramatic shifts in your own thinking. And then it could also lead you to losses because you may sell before it actually happens, or maybe you've miscalculated. And so there's all kinds of things that can really, emerge in someone's mind that can hurt their portfolio over time. So you're probably familiar with the concept of the investor emotion cycle, right? Where people begin, when they begin to invest and they see the market going up, they feel some optimism, right? And then as the market goes up more, they begin to feel excitement. And then as it goes up even more, they feel thrill. And then they reach a point of euphoria where the stock market is going up, 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 and it just feels like amazing. Wow, it just keeps going up, up. Think back at 2021, or some of the other years that we saw the market just rallying big, and you just have euphoria, and people are like, it's never going to end, And anybody who says it's going to end is considered to be an idiot. Like, oh no, how can it possibly go down? It's going up, up, up. Okay, well, at that moment of euphoria, where the market is up really big, that's the point of maximum financial risk. Okay. So, but that tends to be where people finally get the memo and they begin to buy because everything is up. Okay. But at that moment, that's the point of maximum financial risk. Okay. Well, once we've achieved that euphoria and once we've kind of peaked and everybody's kind of starting to buy in because like, hey, it's going up, it has to keep going up. Well, then the market will begin to come down. And as it comes down, then we begin to feel anxiety. Here's the emotions the investor feels. And then it goes down a bit more, and then you feel a little bit of denial. So, this is a temporary setback. I'm a long-term investor, right? So it's okay. And then it goes down more, and you say, well, it's fear. And then it leads to desperation, and then panic. And then finally capitulation as the market keeps going down. You say, well, maybe the markets aren't right for me, huh? And then it gets down to despondency. And depression, where you're thinking to yourself, and by the way, anybody who, suffered through the 2022 sell-off, You probably felt many of these emotions, right? You probably felt, and some people said, well, I just sold. Well, remember the market started going back up, after it bottomed in October. So many people sold at those lows because they couldn't take the pain, the panic, the desperation, the capitulation, the despondency, the depression, right? And so, but what's ironic is when you're in that moment of despondency and desperation and depression, well, that's the point of maximum financial opportunity, right? The moment that we feel like, oh, we need to sell, right? That's the moment of maximum financial opportunity, right? It's the perfect time to buy, in other words, right? Just like the euphoria that you were feeling at the top, that was the perfect time to sell. Perfect time to take some gains. Perfect time to take some money off the table, right? You get to the very bottom here of the market. It's come down, 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 down. Finally, it's down here at the very bottom. And you say, oh, it's depressing. You're despondent. Markets aren't right for me. This, I must not be very good at this. And then many people will capitulate and they'll sell. But again, that's the moment of maximum financial opportunity. So it's almost like we have to rewire our emotions. Like we have to rewire how we think about the markets. Because once you bottom, then it starts going back up again, of course, and then people begin to feel hope. They feel relief, and they begin to feel optimism, and it starts all over again, right? So when it gets up to the euphoria, many people won't take any money off the table, and then they'll oftentimes they won't sell, they won't take any money off the table, and then and they may even go even bigger into the market because of that, and then as it goes down and it bottoms out, well, then at the moment of the best financial opportunity they're going to have in a bit, they want to sell. So you can see how through time, our emotions can really wreak havoc on our portfolios. And what we noticed from this study that we had talked about earlier was the fact that these ultra high net worth individuals didn't allow the ups and downs of the market to change their desire to continue adding and buying high quality yielding assets to their portfolio. So when the market was down, instead of succumbing to the emotions, instead of succumbing to the fear, they're like, we're going to buy more because it's on sale, right? We're going to buy more of the good stuff because it's on sale, right? And that's oftentimes what those who are not high net worth or who are not wealthy, they tend to do the opposite. And that's what this study found. And it shouldn't really be surprising because we know the emotions in investing. Warren Buffett said it this way. He said, be fearful when others are greedy and greedy when others are fearful. That's a common way of putting it. So let's just talk about, as we conclude now, let's just talk about a quick strategy that you can use in your own life to become a better investor based upon what we've learned here. So remember, we're not talking about trading. We're talking about investing, long-term investing. And how can we overcome this investor emotion cycle? How can we overcome some of these irrational investing behaviors that cause us to make poor decisions when the markets go up and down, when volatility is wreaking havoc? Well, the first thing that I would say is that you need to develop an investment plan, right? Just like you have a trading plan for your trading, you need an investment plan for your long-term investing. And so you're looking for companies that have a strong competitive advantage in their industry. You're looking for high returns on shareholder equity and total capital. You're looking for companies that have a policy of paying and consistently growing dividend payments to shareholders. You want to find those companies, and if you don't find those companies, well, then you can just use an index fund. But you want to develop an investment plan, and you want to stick to that investment plan. And one of the best ways to do it is to dollar cost average every month or week. Right? You could try to time the market and try to figure out when to add more, obviously. And if you're an investor, you want to buy more when it's down, But the dollar cost averaging is really more realistic for people because everybody's busy. Everybody's very busy and you got a lot of things going on. So you may forget. And if you forget, well, then you're messing up the plan. You can't forget. You've got to put this on autopilot. So dollar cost averaging every month, dollar cost averaging every week or every 2 weeks or whatever it is, just putting it on autopilot and buying those high quality yielding assets for your portfolio. You want to focus on high quality investments. I want to stress this. If you don't know, what you're doing, then you need a financial advisor, obviously. And everybody needs a financial advisor for that matter, because you need a holistic plan overall, not just a stock plan, not just an investment plan, but you need an overall financial plan. But when it comes to investments, if you're dollar cost averaging into penny stocks, well, I don't know how that's going to work out for you. It may not work out. Those companies may not be around in 5 years. So maybe you just dollar cost average a whole bunch of money into companies that aren't going to be here. Well, you don't want to do that. You want to dollar cost average into companies that are going to be here 5, 10, 20, 30 years from now, right? So you want to invest in high quality companies. And many times people are always, they don't have a lot to start with, so they start swinging for the fences. Like, well, I guess I'll dollar cost into penny stocks because those will go up more. Well, maybe not. Maybe they'll even be out of business in 5 years, so who knows if they'll still be around. You want to focus upon high quality investments, right? And like I said before, if it were me, I would prefer index funds if I didn't want to perform in-depth and ongoing stock analysis. Okay, that's what I would do. This is what Warren Buffett has said he's going to do for his wife. Whenever he passes away, the inheritance that his wife is going to receive if he precedes her is 90% of the money is going to be placed into the S&P 500 ETF. His wife doesn't want to have to sit around and think about this massive portfolio of stocks and tracking them and doing analysis on them. She just wants to live her life. And so she's going to have the S&P 500. 90% of the wealth will be put into that. And then, she'll receive dividends from that, and that'll grow. And by the way, that S&P 500, if it continues to do what it's done in the past, it will continue to beat the performance of the average investor. In 2021, that was by 10%. So, if it's you and you're saying, well, I don't know a whole lot about stocks and I don't know if I would trust myself, well, then do an index fund, right? Use index funds if you don't want to perform that in-depth and ongoing stock analysis. Another one that I would say is don't sell in bear markets. The ultra high net worth individuals don't sell in bear markets. They buy in bear markets, right? Just like when the shirt goes on sale, they buy the shirt, right? They don't wait for the shirt to go up, and pay a 50% premium on the shirt. They wait till the shirt is on sale and then they buy the shirt. Okay. So in other words, don't sell in bear markets. Buy more high quality yielding assets in bear markets, right? Use that to your advantage, right? Now you may want to hedge with trading in bear markets, but you want to buy for your long-term investment portfolio in bear markets. Many people are talking about real estate right now, say, well, the real estate market's going to go down. And I say, good, because I want to buy more houses. So I'm ready to buy more houses. I'd like to see prices come down. Bring it. Somebody says, well, that would be terrible. No, it's not going to be terrible. It's going to be good because I'll be able to buy them cheaper. Same thing with stocks, right? So when stocks go down, those high quality yielding assets that you want, when they go down, you should view that as an opportunity, right? It shouldn't be dismal, especially if you have many years until retirement. Now, if you're listening to me today and you say, well, I'm very close to retirement. Well, then you need to adjust your strategy, accordingly. You probably don't want to be in things that could, swing 30 or 40%, in a given year. You want to be in things that are a bit more stable. And so obviously your age is going to determine your strategy. These are just general comments. And also, I would say maybe as a final point is to, take gains. Don't be afraid to prune some of the gains whenever you're in this optimistic market and the bull market's raging and everything's up big. Take gains, take some money off the table and rebalance. Maybe take some of the money that you've got from this stock that has done really well and take some of that and put it into some of the others that maybe haven't done so well, but you expect them to in the future. So, or maybe take some of the money out of the higher risk stocks and put it into an index fund. That way, you won't, really lose the majority of it. So there we have. I mean, this idea of how the rich get richer, or why the rich get richer, it's really due to habits. As this study shows, that the higher net worth households realize that markets go boom and markets go bust. And as a result, what they do is they continue to buy and never stop buying high quality yielding assets during their lifetime. And they just continue to buy. So for you out there listening, dollar cost averaging could be a powerful way to do it. Just do it. This is a habit worth forming. Commit to investing. I promise your future self will thank you. friends, it's Jerry Robinson here from Follow the Money Radio. Are you tired of feeling lost in the stock market and unsure how to make a profit? Look no further. FollowTheMoney.com is here to help you navigate the financial markets and to teach you how to prosper through our time-tested trading and investing strategies. Our team has years of experience in the financial markets, and we have developed our own proven trend trading system for identifying and capitalizing on market trends. When you become a member here at FollowTheMoney.com, you instantly become part of a global trading and investing community and unlock access to in-depth training and education, including video tutorials, live webinars, and exclusive market analysis tools, which includes our powerful Profit Tracker trend trading system. With our system, you'll be able to spot the next big trend and make informed investment and trading decisions that maximize your profits. Whether you're a seasoned trader or just starting out, our services will give you the tools and knowledge you need to succeed in the financial markets. Don't wait any longer to start your journey to financial freedom. Head over to followthemoney.com/join and enjoy a free 7-day trial of any of our membership plans completely risk-free with no obligation. Make 2023 the year that you start your path to trend trading and investing success. Head over to followthemoney.com/join and take a free 7-day trial today. All right, friends, welcome back to the broadcast. We're in the final moments here of today's show. I sure hope this is helpful to you. I thought that study, which, by the way, you'll find a link to it in today's show notes. You'll be able to look at it. You know, I think that study is very, very helpful. Both the study that was done by the, by the academic study and also the Dalbar study. These are very powerful studies that show us how investors can really improve their performance by controlling their emotions, right? And so that's really the big takeaway today. And I hope I've challenged you to take action, to do something for your future self, to do something for your family, and to really just take it seriously and move forward with great gusto. You can really turn this future, even though it seems very difficult, and there certainly are a lot of economic problems ahead. We have a national debt that's outrageous. We have lots of problems. But you really can take control of your own financial life and do your best to insulate and protect your family from the difficulties, that certainly lie ahead for a nation that has become so drunk on debt, right? Let's just face it. All right. Well, with all that said, I'd like to leave you, as always, with a final word, this time by the great Zig Ziglar, the motivational speaker. He had a great quote one time. He said, "Rich people have small TVs and big libraries. Poor people have small libraries and big TVs." It's a very interesting quote, and it really shows the need for discipline in our lives. A person either disciplines their finances or their finances are going to discipline them, right? Just a fact. That's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Till then, God bless.
The information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence.